Welcome, everybody. Special holiday version of the macro setup with my dear friend Dan Nathan. But guess what? We have an amazing special guest I'm going to introduce in a minute. But before we do that, I want a special thanks to our sponsors, Nadex. I know, Dan Nathan, you know this, the premier U.S. exchange for binary options, call spreads, and what, Dan? Please help me.
Knockouts, my man.
Knockouts.
Knockouts.
That's right, knockout. Dan, a little energy here, man. Come on. I also want to thank Open Exchange, who's been our production, the back-end production for everything we've done. They've done an amazing job for the last 3 months. It's been a pleasure to work with Mark Lair and his team, specifically Brendan and Michael. They're fantastic. They're doing more conferences probably than any of these platforms out there. They do a wonderful job. But our special guest today is a guy that cut his teeth in the hedge fund world, Danny Moses. But what I find most impressive, Danny, is you were featured not in one Michael Lewis book, but in two Michael Lewis's books, Flash Boys and The Big Short. You're sort of the Jack Reacher of Michael Lewis. How are you today?
I'm good, man. Thanks for having me on.
It's great to have you. And, you know, what I find fascinating, so I was a commodities trader for a long time. And, you know, my focus was on the next trade every 30 seconds. It was gold going up $1, down $1. And it was very hard for me to sort of take a step back and see the bigger picture. But you have that ability to see the bigger picture. And obviously you did it 12 years ago in terms of the housing market. My question to you, Danny, as we get going, how do you do that? How were you able to step away and say, okay, I see the smaller things going on, but big picture, this is what's setting up. And more importantly, this is how I'm going to position myself.
First of all, it was I was part of a bigger team, and Steve Eisman, Vince Daniel, Porter Collins were on that team. And so we actually were an equity fund. And because we were an equity fund, we approached things from a fundamental basis. We kind of backed our way into the fixed income trade as a result of understanding the balance sheets of these equities. And so we were kind of borrowing the fixed income trade for a while, and then it just started working. And every day we would get an incremental piece of information. But amazingly, it started to work on the first day of the trade that we put on the credit default swaps that went on. And so kind of developed sense of confidence. If you remember in the movie, Michael Burry had put on the trade a lot earlier than we did. And I can tell you if that had happened to us at that point, it would have been tough to hang on. But it was just a confluence of events, understanding behavioral finance, seeing fixed income people make a tremendous amount of money, attending a conference, a fixed income conference, being the only equity people there. So it was just picking up on a lot of different things that were out there.
So Danny, pretty interesting, in the run up to the housing crisis. At the time, were you and your team developing any kind of similarities to the kind of the build up in tech valuations in the late 90s and obviously two very different risk assets, but was the psychology pretty similar? And how did it work with the timing from the moment in which you guys identified the fact that these valuations weren't sustainable or the activity wasn't sustainable until it ended up starting to go your way? Was, the dot-com bubble and burst kind of some form of framework for what you guys were doing into the financial crisis?
Yeah, so the first subprime kind of mini crisis was in 1998, 1999, around the same time as the internet kind of blew up. And what caused that was obviously rates moving higher in the late 90s. Rates were then cut, obviously, late 99, early 2000. Then after 9/11, they were cut a lot, which caused the next subprime crisis, in my opinion. So it happened simultaneously. So, it was just feeling like, you hear the term irrational exuberance. Obviously, I'm not going to use that, per se, but it was very easy to make money back then. And I specifically remember in the winter of 99, 2000, somewhere in there, I was down in Miami hanging out in a pool and listening to a kid who was a freshman in college talking to his father. And his father said something to him like, "You haven't asked for money in a while. What have you been doing?" He says, "Well, I'm trading on E-Trade." And at that moment, I realized, I'm like, hold on a second. It's now reached dormitories, E-Trade. And you see similarities today, right? You and I have talked about gamification of what's going on. And Robinhood has opened up a whole nother door for investors, which can be positive because it allows people to invest in the market. But when things become too easy, or your friend that was lost in life starts making money flipping houses or something like that, you just kind of got to be aware and be honest with yourself that it can't last. So these bubbles, doesn't matter what it is, doesn't matter if it's tulips, doesn't matter if it's internet stocks or mortgage stocks, they always kind of repeat the same exact psychology and the false security that you get.
Yeah, no question about it. And you're right about that. And behavioral analysis, behavioral economics, I'm a huge fan of all that work, and I try to implement it when I can. But I think I want to sort of drill down, Danny, real quick in terms of the gamification, because I think that's important. Listen, clearly, some of these places have done a poor job. Let's just put it out there. But in a lot of ways, they've also opened up investing to a tens of thousands, if not millions, of people who probably would have never found it, but for their presence on the internet, but for the fact that commissions are zero, and quite frankly, but for the fact that there probably wasn't professional gambling for 7 or 8 months. Is that a good thing or a bad thing? I can make an argument for both, and maybe it is both, Danny.
Well, anyone that knows me knows that I'm a big proponent of gambling. I've been involved in that industry before in prior lives, and I'm a big proponent of online gambling, and it should be legal, and it's a great source of revenue. So I will just say this, Guy, you're now looking at, because of quarantine, people sitting at home that have the money are opening up a Robinhood account or wherever their account. They have a Coinbase account and they have a DraftKings account. And I truly believe that there's a group of people out there that kind of treat all three the same from a risk capital perspective. Mm-hmm. I'm in and out of a Bitcoin trade or a Ripple trade. I'm in and out of a Lakers parlay, and I'm, and then I'm in and out of a trade online. So it's kind of it kind of mixes there. Now that's not a huge group, and that's not the institutional business, but I think what we all agree upon in behavioral finance, or anyone that's been in the markets a long time, is normally when it reaches the retail investor, a trade or something, it's kind of over. This has gone much longer, and I think if anything, it's extending that. Which, to your point, Guy, it's not a bad thing that people have access. That the trading is so-called free, although we can talk about how free it is with payment for order flow, but that's a whole nother discussion. But so it is there and it's available. So I think we all agree that stocks are extended. Do you want to get in front of that right now with the amount of liquidity with rates at zero? We can talk about that. I don't know, but the access is there now for all venues. And I think people do incorrectly equate all those three things I mentioned kind of the same. So from a risk appetite, that never ends well, as we know.
Yeah, and Danny, I do want to talk about that, but I want to ask Dan Nathan a question, because I think people confuse this a lot. You hear, and I hate to I don't even use the word on the show, and I've been doing the show now, as Dan will say, for 33 years, but I've never used the word bubble, because I think when people hear it, they automatically think the world's about to go pear-shaped. But identifying a bubble doesn't mean, Dan Nathan, it's imminently about to burst. And I think, in your view, there's probably a bubble developed, ninth inning, eighth inning, in terms of some of these tech names and some of the things you talk about on Fast Money. Can you sort of address that, Dan?
Yeah, I mean, here's a great example. Guy, you and I have been doing, well, you started on Fast Money in 2007. I started coming on CNBC's There for Options Action in 2009, early 2009. We were still in the financial crisis. We weren't really out of the crisis for, arguably a few years, and it became a rolling crisis the way it moved around the world, right? And so I started probably doing Fast Money with you a decade ago. When I think about all of the mini bubbles that our show, we're called Fast Money. We're kind of talking about what happened today, what might happen tomorrow, kind of talking about some trends that are kind of moving up. You had a final trade the other day, a stock called FireEye. It's a cybersecurity company. Back in 2014, this stock went up in a straight line, like, I don't know, 300% or something like that, right? Well, what's going on right now? It flatlined, I think, in like as a teenager for like the last 7 years. There was a massive bubble that inflated, and then it burst, and then it flatlined near zero essentially for a half a decade or something like that. Now, you just recommended it the other day when it was $16, Guy, and it's trading at 26 today. That's a week. So we see these massive bubbles form and burst. We could talk about 3D printing. It goes the Bitcoin thing and everything related to it in 16, 17, burst in 18. Now we're back with a similar sort of psychology. So I guess my point is, as somebody who's been in the business since the late 90s, and I started the business with the tech bubble kind of forming. Danny used that term, irrational exuberance. I remember reading Fed Chair Greenspan at the time saying that. You know when that was? That was in 1996. You know when the stock market topped out? March of 2000. So to your point, I guess, is that the bubble term is a tough one, but to me, it doesn't mean it's about to burst. It means that there is an asset bubble forming. There's a lot of bad behavior on a lot of different market participants, and no one's going to be able to put their finger on when it bursts and who's going to do it.
Danny, I want to ask you, you said something about stepping in front of it. And, I tried to successfully play both tight end and strong safety in college. And Derrick Henry if I had played against him, I'm telling you right now, I would have avoided him like the plague. If you watch what he's done to people, he steamrolls them. And so many of these stocks have steamrolled the strong safeties in the form of short sellers. But I guess now my question to you is, how do you identify, are there signals to identify when the broader move in the market is over, put call ratio? There's so many metrics that people look at, so many indicators. What have you found to be successful for your work?
I mean, certainly bull bear indicators, call put ratios, those are good technical indicators. Short interest is certainly something, ironically, the stocks with the highest short interest over a period of time tend to actually go down the most. But for the market that we're in right now and the ability to squeeze and with indexers and so forth, it just becomes a lot harder. And so it's much easier when rates are higher to make an argument that stocks are too expensive. When rates are this low and you're chasing yield, or you're just chasing performance, it almost is a self-fulfilling prophecy that stocks are going to move higher. And if you go back and look in the last, every cycle actually, it's always rates that cause it. And if you've looked now in the last 2 to 3 years, the fits and starts we've had in the stock market, forgetting the pandemic, for a second, has always been because the Fed tries to raise rates or pulls the plug on QE or so forth. So that's been the one triggering event that you can actually count on for market to sell off. Without that, it becomes fundamentals. But when stocks detach from fundamentals, it's very hard. That's when it becomes, okay, I'm not shorting it. You don't just short stocks on valuation, right? You can, but that works over a longer period of time. But there are certain themes out there and that just, have taken on a life of their own, and it's hard to identify them. I mean, Tesla, for whatever, I'm not going to talk about the stock on this show. It's not long enough, but it's created an entire universe of batteries and autonomous driving and LiDAR and so forth. Do you want to step in front of a SPAC that's buying one of these companies that is a 20, 30 billion valuation? I could argue that's expensive, but Tesla's at 600 billion. So how, so it's all kind of connected. So a long-winded answer to your question is, you want to see that it reaches retail. You want to see the top 20 stocks on Robinhood, not to rip on them, but you want to see that those things are trading, and you get a sense, combine that with the short interest, combine that with, smart institutional investors. Let me just say one more thing about Bitcoin, or let me bring up Bitcoin in this universe. It is clear to me that the institutional investors are buying every time a retail investor sells on Bitcoin. When you see that drop of $2,000 to $3,000 or 10 or 12%, you normally see it snap back. I'm not saying that's how you should trade it. What I'm saying is it's very clear to me that would be the opposite. If I were to say, is Bitcoin a bubble? I would say there's still a lot of institutions that want to own it. It's a finite amount. The stock market, they're issuing shares. It's not a finite amount of shares that's being issued. It's not a finite. So it's just difficult to see. But again, with rates at zero, it's just very difficult to make a call on the market per se. But I do watch various things, the ownership, who owns it. So
let's continue on this rates. Guy has had a lot to say, at least to our Nadex audience over the last few months on interest rates and on the Fed, obviously effectuating, this race to zero. What's different this time, if we think about these two periods, Danny, that we just talked about, back in 2000, when the stock market topped out, the U.S. 10-year Treasury yield was between 6 and 7%. And then in 2007, when the market topped out, it was just north of 5%. So here we are. If you draw, upper left, bottom right, you draw a nice 45-degree angle, and you see how we get to, where we are, just below 1%. So really interesting to me, though, is that if you look over since 2012 and then in 2016, and then where we just broke during this pandemic, that's 1.5% on the 10-year Treasury yield. That was a massive, double bottom that people thought was a generational low. Well, we broke it, and now we're contending with this 1% range, Guy. So my question to you is, and you seem to be in the camp that the Fed has kind of lost control here. What if rates were to head up precipitously? We know when they had that move back to just above 3% in 2018, and to what Danny's point was, is that the Fed felt pressure to obviously raise rates there, and they started doing that. Well, the stock market sold off 20% in a straight line in Q4 2018. So how can rates ever go higher when you think about how much sovereign debt is yielding, a negative yield, that sort of thing? What's your take on that, and what does it mean for other risk assets, obviously stocks in particular?
Well, if you're asking me, Dan, I want to hear Danny's views on this, but I've said it on the show. I've written about it. I've said it on our macro setups. I believe, and I really believe this with all my heart, that some of the biggest villains of the 21st century And there's a laundry list, but on that list is going to be central bankers, specifically our Federal Reserve. And I'm sure that everything they do is with the best intentions, but history is littered with disastrous outcomes born of good intentions. And I think we're about to see it again. And to answer your question, how can rates go up? Well, the Fed can control the front end of the curve. They can't control the rest of it. And I think they somehow think they can control the entire thing, not unlike if you watched Chernobyl on HBO, the miniseries, the same way those engineers and scientists somehow thought they could control that nuclear reaction. And you saw how that worked out. It didn't work out particularly well. And I think that's what's going on here. Your point about late 2018, I think Jerome Powell was correct when he came out and said, you know what, we're going to reduce our balance sheet and we're sort of going to systematically move rates and normalize rates. I think he was on the right path. The only thing that stopped him was the fact that the stock market went down 19.9% in a month and a half. And I think they got a little frightened by that. Oh, and by the way, the president was hammering him every single day. So I think they sort of felt compelled to acquiesce. I think they made the wrong decision. To answer your question, I think the real concern in 2021 is rates going higher in a non-controlled way and the Fed losing control of interest rates. And I think that's where we're headed. Be careful what you wish for. The Fed wants inflation. They have it in all the wrong places. And by the way, it's in asset prices across the board, and they choose not to measure it. So I think 2021, if you're asking me, is going to be the year where you see rates go up in a very precipitous fashion and they lose control and the stock market gets whacked on the back of it. Danny, how far off base am I?
You're not that far off base. I think somewhere along the line, a big, Bernanke, the Fed mandate shifted from unemployment and inflation to stock market. And the feeling was that the stock market can create this sense of security and there's a wealth effect and that'll have a positive impact and grow things. When you change the rules like that of what you were mandated when you began, then to your point, Guy, you open yourself up to those possibilities. Depends on why the rates would go up. Would the rates go up because of inflation? I agree with you. That would be bad. If it went up because of the credit worthiness of the United States, I don't think that's going to happen on a relative basis. We're probably still okay, but that would be painful. So the problem here is that there's no room to cut. Certainly, you can increase QE, but how many more mortgage-backed securities can you buy? How many more treasuries can you buy? How much more? So if there is inflation, and I do totally agree with you that you're starting to see it in various pockets that are not measured correctly. We have a problem because then you're going to have to start raising rates dramatically. And if you do that, you will see this market obviously correct. I think north of 20%. So.
Yeah. And Dan, Nathan, I don't want, again, this politics is not our thing, but, I think it's worth mentioning the fact that when President Trump was candidate Trump, I think he correctly was saying, again, my opinion that, the Fed was creating a bubble with their low interest rate policy. And then magically, when he became President Trump, he completely did a 180 on that thing. And it is what it is. I mean, that is, I guess, politics. But I submit, and I want to sort of talk about this, Danny Moses, as well. But Dan, you first. I think the reason there's such a wealth gap in this country is the policies that we're just talking about. I think it's preposterous. And for the life of me, I don't understand what the Fed is doing buying AAA rated bonds. Why are they supporting asset prices when, quite frankly, that really only helps a small percentage of the populace? For 30 million people in this country, if not more, forget about recession. This is a flat out depression, and that's problematic. And in my opinion, Dan, Nathan, it's all at the foot of the Fed. What do you think?
Well, listen, I think that if the Fed hadn't done and moved as aggressively as they did in February and March, prior to the Treasury and the White House and Congress getting their act together, right, for the CARES Act, we might have found ourselves in really a depression. If you think about it, we clearly would have been in something that looked very different than the V-shaped sort of crash that we had in the stock market. When you think back to 2000, the market topped out in March of 2000 and it bottomed, I think, in October of 2002. And then the market topped out in November of 2007 and bottomed in March or April of 2009. We had protracted bear markets. And, when you think about the monetary and fiscal stimulus that's been thrown at this crisis this year, it's unprecedented. It dwarfs the prior two crises combined, right? And so I guess when I think of, you use that term villain, and who am I to kind of judge, your thoughts on that? I feel like that they've done what they needed to do at a time where politics has gotten in the way of taking care of our most vulnerable citizens, and then also throw on the fact that small businesses in this crisis right now, like to your point, it does feel like 1932 for them, right? If you think about it, if you're running a small business, anywhere in America here. So to me, I feel like, we're at this intersection where bad policy has gotten just kind of gobbled up with some really bad political situations here. And to me, I think the Fed's going to continue to be supportive. I don't think they should be buying some of the instruments that you're talking about, whether it be mortgage-backed securities or triple A-rated corporate bonds, but they need to keep things going because the scar tissue in this economy, we have 10 million Americans who are unemployed right now that were employed a year ago at this time. And it just seems like the gap, that income inequality gap that you're speaking of, is going to be something that policymakers and politicians are going to be dealing with, for some time, at least here in this country.
Yeah, and Danny Moses, I want to ask this question. I don't want to play stock market, and I'm speaking about airlines, just the sector specifically, and I find it fascinating that, again, just my opinion, but it seems the policy over the last decade, 15 years in this country is we capitalize gains and we socialize losses. When things were going great for the airlines, you know what? They were spending 85-90% of their free cash flow to buy back stock. Nobody was asking any questions. Everything seemed to be going well. And again, nobody could have possibly seen what was going to happen or portend, some of the things, the draconian measures that have been taken. But you know what? I don't get paid to be the CEO of an airline. And there is this edict that you should prepare for a rainy day, whatever that rainy day looks like. I guess my question to you is, do you find, I'm insulted by the fact that, airlines are going to Capitol Hill hat in hand, when quite frankly, there are other ways for them to raise money. I know a lot of people get sort of exercised by that. Are you equally pissed off?
I think in general, you talk about the wealth gap, obviously to Dan's point, and you guys, what you just talked about, Guy, has kind of expanded and bifurcated even more in terms of the rich and the poor, the people that really need it. I think there's a moral hazard that's been created in every industry. The banks can take chances because they know they're going to get bailed out. The airlines, obviously, 9/11 was a different story, right? That was certainly an event that was unforeseen, and we wanted to get the economy rolling, and you want to support the airlines and so forth for that. But I totally agree with you here, whether you're a cruise ship or an airline or hotel, and feel bad for all those industries. I agree, but when times are great, you don't want to regulate. You can't be half regulated. You can't be bailed out and then run privately. So there's certainly, we're living in unprecedented times, unprecedented stimulus. In 2008, when the Fed came out with all of their programs, I was very against it. Not because I wanted to make money shorting, because I was like, once you create this moral hazard in this bubble, you will be there. It will be with us forever, and it won't teach this entire generation of people that are now the ones trading, right? They're now the ones buying crypto, the gamification stuff we talked about, have all grown up in a time period where you get bailed out. What is the punishment for? And you know what? Let these airlines go bankrupt. I don't want people to lose their jobs at work at the airlines. I don't want unions to fall apart in the pilot union. But that's capitalism. And you go bankrupt and you restructure the companies, Chapter 11, you come back. That's what every industry. It happened to casinos. It's happened in the past. That's probably the one that has always been hit the hardest in terms of cycles. Don't inflate your balance sheet. Don't buy planes, lease planes, so forth. So, not to answer your question directly. So yes, I believe the entire corporate America has now been sucked into this, moral hazard kind of trade. And I don't think you should be bailed out every time. And I think that's the way many businesses are being run.
It's tough. It's tough to extract from it once you've gone down that rabbit hole. In the final few minutes we have left, Danny, but I'm going to ask Dan first. Is there anything? I know, Dan, you and I work together every night, so I'm very familiar with your thoughts. But as we go into 2021, what is sort of sticking out to you? I know you talked about, some of these new tech companies, some of the valuations, but is there anything sort of on your radar screen as we move towards 2021?
Yeah, I'm really concerned about that. We've seen a bunch of massive IPOs recently trading at valuations at just on a multiple of sales that just are not sustainable. And you think about the winners of the pandemic, some of these companies were private, they've come public, and we know the big ones in the public markets all year long, the Amazon, anything related to e-commerce, the pull forward and a lot of demand. Apple has obviously benefited that a year where iPhones weren't going to grow a whole heck of a lot. Well, iPads and Macs bailed them out, work from home, school from home, that sort of thing. It was just a weird year. So I think in 2021, when we think about the pull forward, we think about valuations, we think about how growth investors think about decelerating growth and what they're willing to pay for it. I think that's going to be a big theme for 2021. And the other thing I'll tell you is that when we started 2020, I think the supply-demand dynamic for growth stocks was a little bit off kilter here. And all of a sudden, I think with all the supply that's come on with SPACs, with a lot of the IPO market opening up, I think we may see investors become a bit more discerning about what they're willing to pay for growth. And I just got to take you back, not too long. Remember when Uber and Lyft went public? The public markets did not like their valuation. WeWork was unable to go public. It went from what, $70 billion to like 2 or 3. That's what happened in the crash in 2000 to 2002. Amazon lost 90-some% of its market cap. So I think the fact that if interest rates are the only thing that's changed right now, at some point in the next year or so, we're going to see the chickens come home to roost because these companies cannot grow into these valuations. So to me, I would say, that is a massive short that's coming. It's going to be a bit more discerning. I think that Apple and Amazon and some of the mega caps will obviously not feel the pain the way that maybe a DoorDash or an Airbnb or a whole host of other companies in the SaaS space, but it's coming. And to Danny's point earlier, your guess is as good as mine of how to play it because you get your face ripped off in the meantime. But I think it's important for investors, at least from a sentiment standpoint, to be cognizant that it is not different this time, and it's likely to end very similarly for some of these names.
Yeah, and Danny, I've seen you interviewed countless times, and I'm not trying to cast aspersions here, but the lame question that you get asked hundreds of times, Danny Moses, what's the next big short? And it's such a lazy question, and I'm not going to ask it because there's no point. But what I will ask you, because I know you're thoughtful, what's on your radar screen right now? You're sitting and watching things. What is sticking out to you like a sore thumb?
Well, let me just tag on to Dan's point that these companies, not the top 5 or 10 that control 80% of the market caps globally, but the names that need to grow into their multiple. Well, if that actually happens and they can actually grow into their multiple, then rates are going higher, because that means we have growth that actually validates those valuations. Secondly, if I'm one of these companies right now, I'm going to go raise as much capital as I can at these prices. Why wouldn't I? Let me get cash on my balance sheet. So if the fear or the short thesis is there's no cash to grow the business, let me go change that thesis. So let me just start with that I think from a macro perspective. These SPACs are interesting to me. And I don't mind the SPAC model. There's nothing wrong with them. And when rates are low like this, you can get away with having money tied up for a couple of years at very, very little return, because what is the alternative, right? But to me, these SPACs, many of them, and some will be successful and some won't, are getting the benefit of the doubt because they're a great way to obviously come to market. But when you think about it, why would a company go into a SPAC, right? You would do that because you either couldn't IPO or you wanted to IPO or you wanted to come to market quicker. You're giving up 25 to 30% of your company to do it, sometimes less, sometimes 20 or 15%. But there's a give up to get. And there's now so many companies are being created out of this right now. So I'm not going to name one particular company in the world, but I'm saying when you see stuff like this occur, when it's that easy to raise money, when it's that easy to just tell a story and go higher, I think you got to be aware. So I'm making a list, not to Chris is checking it twice, obviously, guys. And so I'm going to, look across the spectrum here. And then when the smoke clears at the beginning of the year, I think come up with a list of names, not necessarily that came out of the SPAC environment, but just in general, the names that Dan's talking about. So I'm not going to hammer any one particular area right now or sector. I think that it's a potpourri of opportunities on the short side. But again, I'd like to see rates move higher before making a big bet, obviously anywhere. And I do think that we've seen this, staircase up, elevator down continuously. And I think for short sellers in general, it's been very frustrating because you have to be there on the day and you pain. And then if you're not there on that day, you feel like your intellectual capital has been drained. So it's been a tough go for people that want to try to short, but there are, to Dan's point, if you get past the top 5 or 10 names that are out there, there's huge opportunities on the long and short side. On the short side, you just got to get away from the indices that are really controlling the market still at this point. So,
Dan, it looked like you wanted to chime in real quick.
Yeah, I just want to make one point because this is something I've seen before. We've all seen before. Last night, I'm watching the closing bell on CNBC before we're getting ready to go on Fast Money. They're talking about this company that we were going to talk about, Fubo TV. It's got a $8 billion market cap. It went public through a SPAC not long ago at 10. Yesterday, it was trading above 60. So it was up 500% in a month and a half. The analyst who had a buy on it from the get-go came on closing bell, and she seems very thoughtful. I'm sure she's really good. And they asked her, Guy, what's your next big call? Okay. And she mentions the 4 letters. And the stock I see going across CNBC's ticker is trading up. It was trading up 20% in the aftermarket. Okay. It's up 20% right now. It's a $27 stock. It's trading up $5 or $6. That is not natural. And you cannot blame that on the bankers. You cannot get who pitch SPACs or the VCs who are looking for an exit as fast as possible and as liquid as possible. That is on investors. That is the ones who have, they have their iPhone, they downloaded the app, they put $5,000 in there. It's free trading, right? You know what I mean? And it's all just fun and games until what? Someone gets hurt. So to me, I just think there's a lot of very troubling behavior, and there's a lot of different pressure points going on right now. And I think there's a lot of investors who don't know what it feels like to lose money or be in a protracted bear market. So to me, that's something that I think, has to change before we can really have a sustainable another bull run.
Yeah, I agree. Listen, this has been a great 30 minutes goes by like that. It's pretty unbelievable. And listen, I want to thank our presenting sponsor, Nadex, obviously, Dan, one of the premier exchanges, if not the premier exchange for binary options, call spreads, and what, Dan? What, Dan?
You are a knockout.
I am a
guy,
knockout. You're right about that. I also want to thank Open Exchange. I want to thank Michael Covino, Brendan Bresney, obviously Mark Lair, who runs the entire joint. They've done an amazing job for us. I also want to thank Danny Moses for his time. Danny, we could go on and on with this, but time prohibits us today. But what I will tell you, folks, be on the lookout in 2021, because Dan Nathan, Danny Moses, and myself might be working on something, and I think you'll all find really interesting. I want to thank you for your time. Danny, thank you. Dan, thank you. Folks, have a wonderful holiday. We'll see you soon.
Thanks, guys.
Thanks, guys. Thanks.